I'm Scarlet Fu. This is Bloomberg ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. Ant race. The floodgates are about to open for active, non-transparent ETFs in 2020. How the NYSE is preparing for their arrival. The Spiva Diva, why ASO of S&P Dow Jones Indices says active managers are good at stock picking, but bad at weighting their picks. And high flyers. Biotech extends a blistering fourth quarter run. We turn the microscope on the sector and examine its returns. Love them or hate them, ETFs are here to stay, and in the hands of an ETF authority, you can read a lot from their flows, which means we have Eric Balchunas here to walk us through what he sees right now.
Thank you, Scarlet. Yeah, so again, I sound like a broken record. Since Halloween, basically, it's been very bullish, and the flows this week show that again. There's been a couple blippy type days recently, but the low volume in SPY and overall, and the inflows to me says this will be short-lived, but we'll see. You can see here from the weekly inflows, SPY, the Qs, that's small caps. You've got discretionary, you've got retail, that's a retail S&P. You've even got junk bonds, so it's really a who's who of risk on. This one strikes out to me. This is VEA, this is international developed. Remember, we have not seen international really come on the leaderboard hardly at all, but they are making a comeback. Let's look at that. Let's look at international developed versus emerging markets over this past year, and you can see it's been bad. So they're just now positive for international developed, and we're seeing money into small cap growth value, so it's spread around in that EFA area. Now let's also drill down even further and look at Asia and Europe as regions and the countries in there, and you're also seeing that. Now, this is the zero line, so these plays have been beat up this year, but they are starting to see bids. A big one is EWJ. The Japan ETF has taken in $1.2 billion in the past 6 weeks, and we've also seen a ton of money into some of the European region ETFs. So, Scarlett, look, there's a lot of interest in risk right now, whether it's the U.S., which we know is doing good, but also internationally. Yeah, the money is starting to rotate a little bit here. All right, let's bring in Doug Jonas. He is head of exchange-traded products for NYSE Group, and we also want to bring in Carolina Wilson, who focuses on emerging markets for Bloomberg News. Doug, great to see you.
Thanks for having me.
So U.S. equities clearly the star performers over the last few years, but we're starting to see interest in international markets, and there are all kinds of calls that international will outperform the U.S. in 2020. What are you seeing? What are you hearing at the NYSE?
Yeah, we're seeing both the liquidity, the trading of the ETFs, and also the cash flows. Almost $14 billion in international equity ETFs this year, but the big story has been fixed income. Surprises a lot of people. Almost $18 billion in net cash flow in international fixed income ETFs year to date. So it's really been a big fixed income play.
All right, so international either way, whether it's equities or fixed income. Carolina, the global story, of course, depends a lot on how trade plays out, and we don't know what's going to happen. Some, though, would say that perhaps some of the easy gains have already been made.
I think that's true, and when we look at emerging market ETF flows, Trump trade headlines continue to be that sort of dominating sentiment driver. On one hand, like Eric pointed out, we've seen EM ETFs taking 8 consecutive weeks of inflows, really strong winning streak there for that category as that December 15th tariff deadline nears. But on the other hand, we've seen that surge of inflows, I'll have to say, slow down a bit, as I think investors are exercising caution at year end, afraid to add too much risk, especially because they don't likely want to compromise year-to-date returns. And you have to see the volatility in some of these regions. Yes, Chinese equities make up most of that chunky exposure for broad EM funds, but look at the volatility that has erupted in Latin America and Brazil and Argentina and Chile, for example. Investors also pay attention to those idiosyncratic stories, and I think it makes them a little more risk averse.
As well they should. A big theme for next year, of course, Eric, is the arrival of active ETFs that don't always disclose their holdings. Rachel Evans of Bloomberg News has come up with the best acronym here, ANTS, which are active non-transparent funds.
Yeah, this is all us analysts are interested in this, but regular people should be too, because trillions of dollars are licensing these structures that are active. So a lot of big managers are probably going to use them. Can you handicap the race and just talk about from a trading point of view how this will look to the end investor?
Yeah, I mean, if we fast forward, and what we're really doing right now is we're planting a forest, right? So we're going to add a lot of trees. It's going to take a few years, I think, till these trees flourish. But at the end of the day, the end investor is going to see them as an ETF, exchange-traded fund. Are they an active strategy? Are they a passive strategy? How they invest, that's fine. But I think we can get into the deep wrapper. But at the end of the day, they're really about ETFs. And what does ETFs provide? They provide intraday liquidity. They provide a little bit more tax efficiency. And they provide a wrapper that, frankly, is less expensive for the manager. And so if the active manager can remove 50 to 75 basis points of cost out of the investment vehicle they're providing, us as end investors, we win. Right? We can dramatically reduce the cost of investing. And for the buy and hold investor, year over year, that's a lot of savings that go back into performance.
Absolutely, 70 to 75 basis points, definitely. Carolina, there's a certain irony here, though, that most of the active non-transparent ETFs will be for large cap equities, where there's not a lot of inefficiencies to exploit. They should be in small and mid caps, where there's a lot more room for an edge, for an active manager to find an edge. Or
even in EM or international markets. I mean, it's in those niche areas where active really does get to shine. And so in a sense, where active can be competitive, that the approval for that structure doesn't currently exist. I think the hope is that it will expand eventually to include some of those more international facing strategies once the structure has proven itself in terms of with these more liquid US stocks. But the idea is also that with EM and international markets, that's where we tend to see more spreads, right? So it's also a little more difficult because that arbitrage mechanism, maybe there's concern there on execution.
Now, Doug, you're working with one of them, Natixis, I believe is how you say it. They've got one of these in the ant race, so to speak. Are there going to be any issues with you? You know, you're the exchange sponsoring one. Are the others going to be like treated fairly, basically?
No sponsorship happening at the exchange level. We're doing what we do best, right? We're providing a location for liquidity. So regardless of what the structure an asset manager wants to use, whether they use the Presidian model, whether they use the application the New York Stock Exchange has, or whether they use Blue Tracker model, at the end of the day, the exchange is there about providing liquidity and providing a marketplace for these structures to basically flourish. The key piece that's important is the way that the SEC approval process has occurred is now basically any domestic equity security. So we talked about mid cap, we talked about small cap. All of those securities are now eligible for these structures. So a lot of active managers are thinking, how can I put an active mid cap fund? How can I use a small cap fund? And we think international is coming quickly thereafter.
Balchunas of NYSE Group, thank you so much for giving us a sense of what's to come in 2020 at the big board. And Bloomberg's Carolina Wilson. Now, coming up, ASO, the global head of product at S&P Dow Jones Indices, or as some call her, the SPIVA Diva, will be joining us. We review her firm's latest report that is a must-read for investors. And one fund that caught our attention this week, the iShares MSCI Australia ETF, ticker AWA. It is the largest U.S.-listed ETF tracking Aussie stocks, and it posted its highest net inflows since 2009 last month as the nation's benchmark equity index hit a record high. A reminder, by the way, you can find all the charts that we feature on the Bloomberg at GTV Go. This is ETF IQ. I'm Scarlet. This is ETF IQ. Let's take you through the ETF life cycle, which has three main stages. And step one is the filing. Direction registers its S&P 500 high quality versus low quality ETF, adding to its suite of funds with 150% long and 50% short exposures. In this case, the ETF will go long companies with high quality factor scores and short low quality names. Step two is the launch. First Trust has a trio of active factor ETFs coming to market, large, mid, and small caps. AFLG, AFMC, and AFSM will be actively managed and pick stocks using a combination of factors, including value, momentum, quality, and volatility. And for some, the final stage is liquidation. It is game over for the Defiance Next Gen Video Gaming ETF. Ticker VIDG is passively managed and targets stocks benefiting from the growing gaming market. Top names include Nintendo, Activision Blizzard, and Electronic Arts. It's time to get passive aggressive and track the tensions between active and passive investing. The semi-annual SPIVA scorecard leads the way in measuring how active performs versus its benchmarks. It's a must-read for investors. ASO is known as the SPIVA Diva, and she's a managing director and global head of product at S&P Dow Jones Indices. And we're pleased to have her back on the show. Abe, great to see you.
Thank you for having me again, Scarlett.
Well, the latest SPIVA mid-year report shows mid and small cap active funds holding up better than large caps. And we have a chart that really highlights it. And in the chart, once we pull it up, you can see that the bars going down, particularly for mid caps and small caps in the middle of the board, show the funds are doing less badly. Why is that?
That's correct. We are seeing mid-cap and small-cap managers doing better in this time around, trailing 12 months. We do think it has a little bit to do with drifting into the size category. As you know, large cap has dominated mid and small cap over the last 12 months. So we do suspect the drastic change in number may have something to do with the size drift.
Did the volatility in the fourth quarter of 2018 help the small and mid caps any?
No. The volatility in the fourth quarter of 2018 actually hurt all the active managers across the board. We always hear that, in volatile times, that's time to go active. But what we found was across large, mid, and small cap, nearly 80% of active managers underperform the benchmarks.
Wow, across the size factor as well. Now, how much of these active funds' underperformance overall is stock picking versus, say, portfolio construction, the weight that each stock gets?
I think it's very interesting because a long-only active manager adds value against the benchmark in two ways. One is stock security selection, and the other is portfolio construction or the weighting. I do feel that stock selection, active managers are not so terrible at stock picking, contrary to what people may say. But what they may be not very good at is portfolio construction. I always take S&P 500 as an example. S&P 500 is a difficult benchmark to beat. But if you look at S&P 500 equal weight index, which is taking the same set of securities but weighting just differently, it has outperformed S&P 500 over the last 15 years. So is it security selection? Is it portfolio construction? I do think portfolio construction plays a big role.
So what should those active managers have done better? How could they have weighted their holdings better?
When you look at, we look at across different holdings, equal weighting, market cap weighting, or alternative weighting, we do find that there are pockets of periods over the long term. Alternative weighting could add value to outperformance against the market cap weighted benchmark.
Okay, got it. Now, you mentioned the S&P 500 is a very difficult benchmark to beat. The active managers know that well, and you could certainly see this in another chart that we have in which large cap funds struggle to outperform the S&P 500. Only 30% of these large cap equity active funds outperform over a 1-year period. That's the far left. But over the long term, down to the 15-year period, that drops to 15%, less than 15% of funds. Why is that? Is the S&P 500 just too powerful or influential for its own good? I mean, Jack Bogle of Vanguard, the late Jack Bogle, called it the tyranny of the benchmark.
I think, over the long run, it is very difficult to outperform a benchmark, any benchmark. Yes, S&P 500 has done very well over the last 15 years. Its performance, we've had a secular bull ride, so it has made it difficult for the majority of active managers to outperform. But I don't think that is a powerful beta, or as some would say. What I think is there are other different types of betas that can beat this market cap weighted beta. If you look at some of the S&P 500 equal weight, S&P 500 low volatility, these are different types of beta, but they are constructed systematically in a rules-based and has outperformed S&P 500. So yes, it is, when it comes to market cap weighted beta, S&P 500 is the market barometer and it's difficult to beat. But.
Yeah, Eric likes to call it the beta vortex. Talk a little bit about active non-transparent and how they'll fit into this BIVA scorecard. I ask because Doug Jonas of the NYSE, who was just on, was saying that the fund's lower fees will give them a performance kick, 70, 75 basis points. Do you anticipate that?
I think, when it comes to performance drag, there are three things, obviously, which is trading cost, tax, and management fees. So, many active, non-transparent ETFs claim those three will contribute to the performance. I do think, I do think we need to take a step back and look at if fees contribute meaningfully to the end of performance. So unless the fees are diminished drastically, I do think just tax efficiency alone or the lower trading costs alone will not add to the performance.
Is 70, 75 basis point lower in fees a meaningful diminishment?
I think, it depends on strategy by strategy, and we have to look at that, yeah.
Okay, direct indexing, of course, is the next step. It's like the next evolution, bypassing the ETF structure entirely. How does this affect S&P and the index business overall? Are direct indexers paying license fees to you guys, to index compilers?
I think direct indexing is the latest buzzword we're hearing, but if we look at it, take a step back and look at it, it's been around for quite some time. What is different this time around is technology. Technology is enabling that to be available to smaller investment amounts. So in our point of view, this is no different than a separately managed account. We do feel when it comes to our point of view, when whether it's an SMA or direct indexing portfolio, if it's based on the underlying universe is based on our index, or the security selection is based on that universe, we find, or tracking our index, we find that to be a licensable event, and we consider it to be our intellectual property.
Okay, so a revenue generator then as a result. ASO, the Spiva diva of S&P Dow Jones Indices. Thank you so much.
Thank you.
Now coming up, we put biotech under the microscope. The sector has been red hot of late, leading gains for the month of November. And for a drill down into all of Bloomberg's ETF content, check out bloomberg.com/markets/ETFs. This is ETF IQ. I'm Scarlet. This is ETF IQ. Now, for every ETF that offers exposure to a factor or a strategy, others are usually quick to follow. Take low volatility or minimum volatility funds. I counted at least 40 such funds listed in the U.S. Among them is an Invesco low vol fund that's also got low sensitivity to interest rates. Eric Balchunas is back to give us the drill down into one of those funds, and that is XRLV.
Thank you, Scarlet. Yeah, so this is kind of a sequel, in my opinion, to SPLV, which is the one everyone knows. That goes out and looks at the 100 least volatile stocks in the S&P. But one of the wraps on SPLV is that you get overweight sectors that are going to move with interest rates. So if rates go up, it could get hurt, right? Utilities, staples. This tries to answer that objection by having a low vol product that is not rate sensitive. So you can see here, it's a pretty big hit, 166 million. 25 basis points, very cheap. Let's look at the sectors. That's really where the difference is going to be highlighted here. So SPLV versus XRLV. The biggies here are going to be real estate, which we know is rate sensitive. Look how little XRLV has. And then utilities. But also look at financials. Financials actually move up with rates because banks lend money, and you'll see way more weighting in that here. That's also part of that rate sensitive play. Let's look at the performance between these two in the first half of last year is when rates rose to see if it works. And it does. It definitely did a little better than SPLV, although not a ton. So I think that's something investors will have to weigh. But, Scarlett, I think certainly for investors who like that low vol play but are really worried about the rate component, this is a solution.
All right. Well, joining us right now is Gary Stringer. He's president and CIO of Stringer Asset Management. And Gary, you're an ETF strategist, and one of your firm's holdings is XRLV. Talk to us about how you use this fund. Does it replace a low vol or min vol fund like SPLV or USMV in your portfolio?
It doesn't. We use it as a complement to the other low vol strategies and the more defensive strategies that we're implementing today. So as our broad outlook is constructive but also conservative, we don't think this is an environment where we want to be real speculative one way or the other, overly defensive or overly aggressive. We think the economy and the markets have reached a level of equilibrium where interest rates will stabilize. And equity markets will stabilize as well in terms of total returns going forward. So the way we're using this is to complement some of our other low vol strategies. And you pointed out the heavier weighting to financials, but it's not necessarily the traditional banks that this ETF owns. It owns a lot of insurance companies that fall into that space.
Gotcha.
And these are financial sector companies, but not nearly as interest rate sensitive as the banks might be.
Now, Gary, you are an ETF aficionado. That's all you do is invest in ETFs. So you brought us, or I picked out some of your non-obvious ETF picks. XRLV is one. Another one is IYLD. This is the multi-asset income ETF. People want yield. This is sort of like a choose all the above for yield, right? And talk to me about why you like IYLD.
IYLD is a nice fit for us, again, complementing some of the other things that we do. We consider this as part of one of our more non-traditional ETFs that offset some of the equity sensitivity in our portfolios. So this portfolio gets nice yield to it. It has a yield of around 5%, but it's not necessarily stretching for you like you might see with a bunch of loaded fixed, high yield bonds and those kinds of things in there. It's broadly diversified, and we expect it to generate about 70% of the total return of the equity market with about a third of the risk. So that's a nice defensive component for us in these markets.
There's a theme here about defense and safe plays here. Another holding that intrigued us on that list of unconventional ETF picks is the iShares medical devices. It's pretty niche and pricey, but it's fairly big, which surprised us, $4.6 billion in assets. How'd you find this one, and what do you think is driving its performance?
Right, so the IHI, the medical devices, is one that we've used off and on over the years as a tactical investment for us. We fundamentally like the U.S. healthcare space, but when you think about broad healthcare, it's made up of a lot of big pharma companies, right? Yeah. And they tend to be very politically sensitive. Yet the medical devices, you see these guys getting dragged out in front of Congress and talking about the prices of drugs. Well, you don't see Medtronic getting dragged in front of Congress talking about the prices of artificial hips and knees, right? So it's the same fundamentals, but much more, we think, less politically sensitive. We actually just backed off that position because it's trading at 44 times next year's earnings. And so we made a nice gain in it, but it's like, how much more is there in the tank in this thing, at least for now? We'll probably be back into it at some point when the price is a little more attractive for us.
Yeah, along the way, you avoid the political headwinds.
And infrastructure, NFRA, that's a flex shares product. Most people would think of the iShares of the Global X. Why this product and why infrastructure? Because it doesn't look like a deal is going to happen anytime soon.
Right. So this is more of a global approach for us. It gives us the opportunity. NFRA is a global ETF, so it's not just the U.S. And it gives us an opportunity to participate in some of the foreign equity markets that are trading at a reasonable valuation, but it's not very economically sensitive. We're not big fans of the European banking system, for example. I don't know what they're going to do about Italian banks. But this is an ETF that if the global economy is accelerating, and it's all about the pace of growth and the pace of change and the change in that growth, if it's accelerating, this is a strategy to lag because these are very consistent consistent revenue and earnings-oriented companies. Mm-hmm. But in a choppy environment, when global growth is kind of steady or declining, this will hold up great because it's companies like national railroads, et cetera.
All right, Gary Stringer of Stringer Asset Management, thank you so much with this list of unconventional ETF picks. Now, we like to say the industry has something for everyone. We mentioned medical devices. How about biotech? It's been on a tear this quarter thanks to some timely M&A. So here's a fund that's stocked with some potential buyout targets. Banking on a breakthrough. The Alps Medical Breakthroughs ETF tracks biotech and pharmaceutical names with one or more drugs in phase 2 or 3 of FDA clinical trials. Trading under the ticker SBIO, the fund is made up of U.S.-listed small and mid-caps. Each company must have enough cash on hand to last 24 months. Investors are hoping that names including Acadia Pharmaceuticals, United Therapeutics, Allakos, and Ligand Pharmaceuticals hit it big on the next new drug. While that risk on a big payoff can result in a hefty reward, it also comes with a high risk if the companies fail to deliver. SBIO has some $200 million in assets and an expense ratio of 50 basis points, which is cheaper than its rival BBC. Both ETFs launched in December 2014, and over that time, SBIO is the clear outperformer, returning around 65%, which is ahead of the S&P 500 Biotech Index. SBIO gets a green light in the Bloomberg Intelligence traffic light system. Biotech a big winner.
Biotech just doesn't quit. Every year the leaderboard, people come and go, but biotech's almost always there.
It's a consistent winner then. That does it for ETF IQ. Be sure to catch us next Wednesday. This is Bloomberg.